Hello, dear friends. My name is Clive Thompson. Today I'm going to look at some of the questions that I have received on YouTube in the comments section or via LinkedIn related to my videos about investing in stocks. Now, I've been investing for 50 odd years and I've learned a lot of tips and tricks. I've also made some mistakes and I hope not to make as many mistakes as I did half a century ago. So I've got lots of questions coming and they're interesting questions. I'm going to read some of them to you and give you the answers. So the first question, this one comes from Henry. And he said, Dear Clive, I've been following you and Mario for a long time. Thanks to the two of you, I have been buying gold and gold miners since 2 years ago and topped up quite a lot after your video a few months ago about gold miners. I hold Gold Royalty, West Gold, Equinox, Centerra, Kingsgate, McEwen, and Ramelius. Yes, I know all of those gold mining companies. They're all good ones, by the way. I also have the GDX and SILJ. Those two are the ETFs which track the gold mining companies. The J, GDXJ, stands for the junior gold mining companies, the smaller ones, and the SILJ is the smaller silver mining companies. And he goes on, I think it may be time to start buying copper and copper companies. Do you have any suggestion, not financial advice? I do my own research. And could you do a video on the copper miners just like you did on the gold miners? Do you have a newsletter? I would gladly pay for a subscription. Thanks for your fantastic videos. Please keep up the good work. Well, Henry, copper miners, I'm not researching them at the moment, but I do know there's a number of big ones. You can buy Southern Copper. I don't know the symbol for that one. Or you could buy BHP Billiton. It used to be called Broken Hill Propriety. BHP Billiton or BHP PLC. They're big copper miners. Also, I see you've got McEwen in your portfolio. McEwen owns a subsidiary called McEwen Copper Inc., which has a big copper mine in Argentina, I believe. Also, I see you've got Centerra. I think they have some exposure to copper. You might want to just double check how much that is. Okay, so let's go to the next message. This one came from Hans Peter. Dear Clive, thank you very much for the video on Saturday about how to pick your stocks for your portfolio. So thank you for that message. Yeah, now just to mention everybody, I did a video on Saturday called How to Build a Benchmark Beating Global Stock Portfolio for 2026. I'll put the link to that video underneath this one. And I got loads of really fantastic comments on it, which you can see here. I mean, these are really wonderful comments that people wrote. Enjoyed it very much. But basically, I'm teaching people how to pick a portfolio of really good stocks, safe stocks, stocks which should go up over time, not individually, but as a collection, they should perform better. And they should do, well, I hope they'll do as well as the portfolios I produced in the past. I have, over the years, produced a couple of rather good portfolios. So I publish them on LinkedIn every year. These portfolios are called Beat the Benchmark. So Beat the Benchmark 2024 and Beat the Benchmark 2025 have been published on the 1st of January each year, or maybe on the 31st of December. And you can see them if I show you here. Let's just go here. Not that one. Where is it? There we are. That one. So the Beat the Benchmark portfolio 2024 is up 49% since 2024, and the 2025 portfolio is up 51% this year. So doing rather well, and of course beating every benchmark. You know, Nasdaq's up 17%. No guarantee it will happen in the future, but I'm doing my best. Let's come back to the question he asked. Is that how you pick the stocks in the 2024 and 2025 beat the benchmark portfolio? Well, yes. Basically, this video that you saw, how to build a benchmark beating global stock portfolio for 2026, which I did a couple of days ago, was indeed how I built using the same methodology you see there, was indeed how I built those last two portfolios. And yes, I did use the same program, which is called Simply Wall Street. And by the way, just to mention, if anyone would like to watch that video, you can use the program Simply Wall Street completely for free and do everything I did. But if you want to upgrade to the unlimited version, as it's known, which gives you unlimited portfolios, then there's a 30% discount. So it's going to cost you, even for the most expensive version, less than 50 cents a day if you want to use it with the affiliate link under my video. It's obviously much more than that if you don't use the affiliate link. So he said here, I bought Rheinmetall. So Rheinmetall is a German defense manufacturer. So he said, I bought Rheinmetall, which was in the 2024 portfolio, the beat the benchmark portfolio. And I was really pleased to see it made it to the 2025 portfolio. Yes, I put Rheinmetall in both portfolios. It passed muster both years. He says, it's up 500% since I bought it. I'm thinking of selling it. What do you think? Will it be in your 2026 beat the benchmark portfolio? Well, as you saw in that video, how to build a benchmark beating global stock portfolio, I did, in fact, come across Rheinmetall as a candidate for the 2026 portfolio. That's not definitely that it'll be in. I haven't finalized the portfolio yet, but I would say there's a better than 50% probability it will go into the portfolio. So kind of coming back to your question, which was, I'm thinking of selling it, what do you think? You've got a huge profit, Hans-Peter. So I guess you're from Germany with the name Hans-Peter. And Rheinmetall is a German defense manufacturer. So I think what you could do, Hans-Peter, is top slice it. In other words, sell part, keep part. I never advise selling everything in your portfolio which is showing a profit. Otherwise, you'll just end up with a portfolio of losers. So it's nice to have some winners in your portfolio. That's why, don't sell it all. Just sell a little bit to, or some of it anyway. At least keep your initial position, if not a bit more. So it's not all in or all out, and certainly it looks like it's a very good company. It might well go into the 2026 portfolio on the 1st of January coming up. Let's go to the next message. This one came from Adam. Hello, Clive. I purchased a license to Simply Wall Street, so that will be cost with a 30% discount. That'll be costing you less than 50 cents a day. And moving to my pension into a SIP, that's a self-invested pension plan from a managed fund. So the advantage of a SIP is you can choose your own investments. That's for UK investors. This should happen in time to follow your 2026 portfolio. That's great. I have noticed that a lot of your picks are not available to me, sadly, such as the African ones in your hot picks list. Okay, I don't have any African ones in the hot picks list, but I think there was one which turned up called West African Resources, which I think is an Australian company. I haven't looked into it, but it's definitely not from Africa because I excluded all African countries when I was doing my filtering. So it would have been from a company quoted in a G7 or G20 Western country where you can trade stocks easily. But I get a lot of messages from people saying they can't buy stocks in a particular country for some reason. The reason for that is many brokers are quite parochial. They just buy and sell shares in the local country and maybe the USA. But if you hunt around on the internet, do a bit of Googling. I think you'll find some brokers who have many, many countries under their belt. I've heard, but I haven't checked, that Interactive Brokers does. I know that Swissquote in Switzerland does. But of course, any Swiss bank should give you access to at least 20 odd countries if you're buying stocks. But it depends on how much money you've got, whether you can afford to pay the brokerage. So you've got a trade-off between the very low brokerage brokers, the ones who charge nothing or almost nothing, and the ones who give you lots of access but maybe charge a bit more. There's no perfect answer to that. Okay, let's go to the next message. So this one came from Rodney. Hi, Clive. Regarding REITs, I wish to ask your feedback on this grok prompt. Let's just talk about REITs first. REITs are real estate investment trusts. A real estate investment trust invests in properties according to its mandate. So you might have a real estate investment trust investing in residential properties. You might have one investing in medical centres. There might be one investing in shopping malls. There might be one investing in theme parks. So there are, all around the world, you'll find hundreds and hundreds of real estate investment trusts. This is a company quoted on the stock market. You can buy and sell it every day, every minute you can. And you know that the underlying portfolio is a portfolio of properties, might be office buildings, who knows, it depends on what's inside. And you can find that very easily by going to the website. It might be a gym, they might be specializing in keep fit centers, gyms, for example. So you can buy different types of real estate investment trusts, REITs as they're known, and they typically pay you a dividend corresponding to all of the rent they collect minus the costs, the management costs. The good thing about a REIT is you don't have to deal with the tenants. You don't have to deal with repairs. You don't have to deal with insurance. You don't have to deal with the taxes. I mean, you'll have to pay taxes if you make a profit, no doubt. But all of the administration which goes with handling a real property is done by a company. All you own are shares in the company, the real estate investment trust. Now, one of the features of real estate investment trusts at the moment, and it's not always been the case, is that they're mostly trading at a big discount to the net asset value. So you might, in some cases, find that the asset value is 100, but you're buying the real estate investment trust for only 50. So it's a bit like buying the underlying portfolio of properties at half price. That's kind of the state of play of the REIT market at the moment. Let me read on to this comment here. I wish to ask your feedback on this grok prompt. Grok is an artificial intelligent large language model like ChatGPT. You can ask it any question. Grok is quite good on investments, I'd say. So let's look at feedback on the Grok. I'll go down to the bottom of your question where it says the prompt. That's what you write in the question. The prompt he gave is, you are an expert investor in REITs. Very good. What are the top global and UK REITs to invest in for regular, well-supported, high dividends with low gearing? Explain your rationale and examine the company forecast for growth and dividend for the next 2+ years. Rod, that's a very good prompt and should give you a good result. But just a couple of comments on that. You've specified high dividends. Now, high dividends is an investment style. So if it only finds you real estate investment trust with high dividends, that's going to be a particular subsector of the REIT market and perhaps not the most attractive for a capital gain point of view. So I always advise diversifying across all the different types of REITs. Some will be higher income and some will be lower income, and also across all different countries. So you don't have all your REITs in the UK or all your REITs in the USA. You want to have your REITs in different or exposed to property in different countries of the world And you want to have REITs which are exposed to different types of property. So some will be exposed to shopping malls, some to office blocks, some to residential, and so on. And there could be 15, 20 different types of property that you might get invested in. Let's go on with your question. So I've told you what I think of your prompt. Should I invest in REITs now or wait until you publish your 2026 portfolio, as that will list your targets for the next year? Okay, so first of all, is real estate too expensive? It might be, but on the other hand, most of the REITs I look at are trading well below the net asset value. So you're kind of buying those properties at what people think next year's prices will be, i.e. lower. So you don't need to wait on those grounds, because at the REIT's price, which is not reflecting net asset value, it goes up and down irrespective of what happens to the property price, because that's the stock market for you. And basically, there are more sellers than buyers out there at the moment, which means that the price has gone down. You're probably choosing a fairly good moment to be going into them. And that's not investment advice. I'm just telling you my personal opinion. And if you're going into the lower price, you're probably getting a better yield than you otherwise would at a high price. Rod goes on, P.S. I was trying to avoid pure USA REIT recommendations, as I read their property markets are very likely to hit a crisis in valuations anytime. You may feel or know differently. Well, Rod, I do agree with you, but then, as I said, many of these REITs are trading well below their net asset value, so that's kind of taken into account by people's expectations in the market. So I'll go back to Rod. There we are. Let's go to the next question. Okay, the next question comes from Jeremy. Good day, Mr. Thompson, and thanks for connecting. It's my pleasure, Jeremy, and thank you very much for being a fan. I'm Jeremy, I've blanked out his name, originally from the UK, but now living in Thailand. I have significant cash savings in dollars and pounds held in UK and Isle of Man banks, though I know this isn't the most strategic setup. Jeremy, I agree with you. Keeping all your money in banks is not a great idea. It's not diversified. Your money's going backwards as the government prints more and more of it. And do you trust the banks? Well, they're safe until they're not. And of course, you need to know how much the government guarantee is. And would it be good if all the banks start to fail at once as they did in 2008? So, yeah, it's not as per your comment, you know it's not the most strategic setup. I've sought advice from various financial professionals, but it often felt like they were pushing investments and products that benefited them more with what I suspect were hefty commissions. Well, Jeremy, you know what they say about financial advisors. What we're combining is basically your money with their experience, and that will give you, or rather, will give them your money, and you'll get the experience. So you're not happy. You probably don't want to be going with a financial advisor at all. Let's just go back and have a look what else we got to say here. So your head is spinning. My head is spinning, and I feel like a rabbit caught in the headlights. Yeah, so it sounds like financial advisors, no matter how honest or good they are, is not for you. I also hold a fair amount of physical gold, which has performed well over the past year. Indeed, gold has been a massively good performer. You could be up 50 or more %. And so I've considered keeping enough cash for 5 years of living expenses and going all in on gold and silver. But I'm unsure. Well, Jeremy, and then he says, could I offer any financial advice, paid or otherwise, or recommend a reputable professional in the financial advisory industry who could point me in the right direction? Well, Jeremy, I don't do financial advice, and I'm happy to answer your questions, but I don't get paid for it and don't want to be paid for it. I do everything for free. Would I recommend a professional in the financial advisory industry? No, I don't want to do that because two reasons. First of all, with your experience of feeling that everyone's trying to rip you off, I think you'll just get that feeling. And secondly, I'd feel responsible if the financial advisor I introduced you didn't actually deliver what you want, which is a positive high return. So, Jeremy, what's the solution? I think the solution is to get yourself a book along the lines of a beginner's guide to investment and learn to invest in lots of things. Now, I understand where you're coming from, saying keep 5 years of cash spending money and put the rest in gold. But even then, that's a risky approach. Even though I like gold, I think it's a good investment, not financial advice. I think it could, there are things which can go wrong with every asset class. So it's not really what I would recommend. Anyway, so I would be more diversified. In other words, you want to hold some real estate investment trusts, some equities, and maybe some other types of things, private equity. It depends on what's around, but have a look at all the investments. Don't go into anything unless you completely understand it and know what you're doing. And initially, just to feel it out, sound out, go in with very small amounts to see if you're happy with it. But no, I don't recommend you buying lots more gold, because you say you've got half your money in gold already. That's more than enough, probably too much from a risk perspective, not from a performance perspective. I think it'll do well in performance terms, but I can't tell you to do that, I'm afraid. Right, let's go on to the next question. So that was Jeremy. And the next question is from Martin. So Martin says, "Thanks, Clive. I really appreciate your help. It's been my pleasure to help. Thanks for alerting me to the scammer too." Oh yes, I should comment on that. Every time I do a YouTube video, there are scammers who enter the comments, usually with and there is usually one comment with 14 replies or something like that. So the first scammer will say, "Hey everybody, anyone know how I can make money trading Bitcoin or something?" And then someone will reply, "I met," and then some name, who is really good at investment, turned $1,000 into $10,000 in 2 weeks. The next one says, "Oh, do you know her? I know her well, she's doing well." And then there'll be a series of people recommending this particular person. It's all scams. They're out to steal your money. They'll try to redirect you to WhatsApp, and that's what happened to Martin. Someone on YouTube made a copy of my photo, like my image, made a copy of my name, almost the same with one letter changed, and replied to Martin and said, "Hi Martin, contact me on WhatsApp, and I've got some questions about your comment." And of course he contacted them, and then he wrote to me because he didn't understand the answer, and I said, "Well, you're being scammed. Don't communicate with this person. Block him." So that's why he said, "Thanks for alerting me to the scammer." In fact, the way he contacted me was via LinkedIn, because he tried to communicate with this scammer via WhatsApp, which was obviously the wrong thing to do. And he's put the YouTube address of the scammer. The scammer was called Clive Thompson -4P4G, whatever that is. And he says, "It looks like they've reached out to people who comment on your videos." Yeah, that's very true. A lot of people get replies from people pretending to be me. It's not me. I mean, it is me if I answer your question. It's not me if I'm trying to make you go and talk on WhatsApp or Instagram or anywhere like that. Now Martin asked me, "Do you think a strategy of equal gold mining shares as to actual gold and gold ETFs, so 50-50, makes sense?" Yes. Yeah, I think you should have a bit of everything. So you should hold some gold mining shares, you should hold some gold, and you should hold some gold ETFs, i.e. all three. I'm not saying, so you said 50-50, I would say 30-30-30 or 33-33-33. I am thinking with greater upside with the gold miners. Yes, I agree. The gold miners should do better logically, but it's not gold. Obviously, if things go the wrong way, you've got a leveraged effect to the downside too. Gold miners can and do go bust when the gold price is low, sometimes. Gold will never go bust on you. It can't default. So there's the difference. So he says, I'm thinking with greater upside with the gold miners, so perhaps slant it 75-25. Okay, yes, as long as that's not all your assets, as long as it's only the part which you've decided to allocate to the metals and minerals sector. Let's say you've got 20% of your portfolio allocated to that sector. Yeah, why not put 3/4 in gold mines and a quarter into physical gold? That's nothing wrong with that. Still, most of my assets are in S&P 500 type shares. Okay, you are diversified, that's good. Global ETFs, even better. Cash, good, or property. Well, we don't want too much cash, but property, I assume you're using real estate investment trusts. That's great. Otherwise, you've got direct real estate. Sounds like you're well diversified, which is a good thing. But I am aiming for maybe about 10% assets in gold. Well, that's fine. That's more than most asset managers are doing. They're sort of at 1 or 2% and 1 or 2 or 0. 1 or 2 of them are going to 5. So if you're at 10, you're above the average. There's nothing wrong with going higher, but not too high. I'm thinking of putting 10% in gold of some sort to protect against the worst. Maybe I should be even looking at 15 to 20%. Thanks again. You know what, Martin? Nothing wrong if you want to go to 15 to 20%. I would say when I started out investing in gold and silver, it was probably north of 10%. But given the rise in prices, and I haven't sold any, I'm probably closer to 20 to 25% range at the moment. So I don't think you're going wrong if you put that much into gold, 15 to 20%. Right, shall we go to another question? Okay, this is quite a long one. Let's have a look at this. This question comes from Roy. Thanks for your video. They're great help to someone like me who is new to investing. Very glad to see the current returns on gold and silver, which is where I've gone in heavy. Well done, Roy. I'm glad you're making a lot of money. But I have a general question. I hope you can help me with it. I've now got 45 investments in Trading 212, which are a mixture of ETFs and stocks. The stocks are a mixture of miners and then some FTSE 100 dividend-paying companies. I've also got some other ETFs, maybe 12 or so, in a SIP, that's a self-invested pension plan in the UK, on Invest Engine. So I used your screener tools. That would be the Simply Wall Street that you get a discount on if you watch my video a couple of days ago called How to Build a Benchmark Beating Global Stock Portfolio for 2026. That's this video here, the one on YouTube where I got quite a lot of likes. So you can see the comments there, very good comments. Let's go back to your question, Roy. So I used your screener and created a new portfolio pie ready for Trading 212. A pie is a group of companies where you put some money in and you get the same amount invested in each. That includes 30 more companies. That's another 30 on top of the 45 you already own. I haven't invested in this yet. But my question is, how many different individual investments is it good to have? Does one just end up losing track of them all, as there'll be so much news daily on all of them? Or is it a good strategy to say just to buy the 30 in a pie, keep funding it, that's putting money in every week or every month, and your exposure to each investment gets bigger, and just leave it for the long term and perhaps review, say, every quarter. I guess it's just trying to get a balance on how much time I spend on this. Just wondered if you have any advice. Well, you bet I do. And I think a lot of professional investment managers won't like my advice, but this is what I think. You can never have too many investments. You can often have too few investments, and the worst thing you can do is monitor them on a day-by-day basis or worse. So let's imagine you've got just one investment. I'm going to say Bitcoin, for example. I'm not proposing or recommending Bitcoin, it's just a comment just to make it easy here. And you watch the price every minute, every hour on your phone, and then some bad news comes out and everyone's writing, oh my God, this is the end of the world, Bitcoin's going to go down. What do you do? Well, you've just seen the news, you better run and sell your Bitcoin quickly before everybody else. And when you sell it, the Bitcoin price is already down, of course. And then a week later, there's some good news, there's a new ETF and the Bitcoin price is going up. And you think, oh, perhaps I shouldn't have sold it. So you rush to buy back and you're paying back more than you sold it for. And this process repeats itself week after week with good news, bad news, good news, bad news, because everything, every investment will have good and bad news. You'll get the good news, you get the bad news, you get the good news, the bad news. And if you watch the news, you're going to be buffeted by that. You're going to be tempted to sell when you see the bad news. You're going to be tempted to buy when you see the good news. So in a way, the best thing you can do after you've bought an investment is not watch it. Maybe you watch it, look at it again every 6 months or a year or every 2 years. But so to avoid that risk, the more investments you've got, the less likely you are to look at them. And the less likely you are to look at them, the less likely you are to be buffeted by the daily news. All I say is when you buy an investment, if it's good enough to buy on day one, buy it and stop looking at it. Don't buy it and then watch it in case there's some bad news, and then next week, oh my God, I shouldn't have bought it, there's bad news, come out. Otherwise you'll end up with excessively trading, doing lots of buys and sells, and you won't make nearly as much money as if you just bought to hold. Because even when you've got stocks with bad news, it's only a question of time before the good news comes back. So that's the first thing. I would say there's no such thing as too many investments. But there is a question as to how many is the minimum number of investments. People often ask me that. So if you're very young and you have a conviction and you've got decades ahead of you to make the money back, and I wish I knew this when I was 18 years old, but if you're young and you have a conviction, why not put everything you own, 100%, into that one investment and pray that it comes right? Now, if your conviction turns out to be wrong, it doesn't matter, because you won't have lost much money because you're young and you haven't saved much, and you've got the rest of your career to make it back and try another time. But the question is, what's the minimum number of investments you should own? And my idea is this. You take your age and subtract 20. That gives you the minimum number. So if you're age 21, take off 20, and that leaves you with one investment. If you're 25, take off 20, you should have a minimum of 5 investments. Not a maximum, you can have many more than 5, but minimum 5. If you're 60, you don't have many years to work left, so you should be very diversified. So 60 minus 20 gives you a minimum of 40 investments. At my age, I'm 68, I should have 48 investments as a minimum. In fact, I've got a lot more than 48, because there's no such thing as a maximum number. But the advantage of having a lot is I don't have time to look at them. And by not having time to look at them, I don't trade them in and out. I just hang on to them. And because they're all good investments on the day they were purchased, some will go down, some will go up. But generally, I'm starting off with the winning stocks, and a year later, they're probably still winning. To make an analogy here, imagine a car race, and the cars are going around the track. And after a couple of laps, you look at the cars, and you can see that some of the cars are doing better than the rest. They're ahead of the pack. Let's say there's 10 of them ahead of the pack, 10 in the middle, and 10 behind. So you're allowed to bet on those 10 cars which are winning the race at the moment, because there's many more laps to do. You know that during the course of the rest of the race, some of those cars which are in the lead will fall behind. That's just statistics of the way it is. But the probability is when you get to the end of the race after 20 more laps, out of the 10 which were in front after the third or fourth lap, many of those will still be in the lead, in the top 10 by the time we get to the very last lap. And so you'll have more winners than losers. So buy stocks which look really good on day one, forget about them. Don't worry about the fact that sometimes they fall behind and go ahead. Collectively, they're probably good stocks, and you'll after a while you'll have some losers and some winners, but you're probably going to have more winners. But if you trade every single one of them, selling them on every bit of bad news, you won't have any stocks left, because sooner or later there's going to be bad news on all of them. That's just the way the cookie crumbles. So thank you, Roy, for your question. And the good news is, if you've got a lot of stocks, you don't have to spend a lot of time on them. You can forget about them. Next question comes from Ernie. Hi, Clive. Love your YouTube posting. When you update your portfolio schedules around late December for 2026, would love to receive it if possible. Okay, everybody. So every year I publish on LinkedIn what I call Beat the Benchmark portfolio. The name is, last year's was called Beat the Benchmark 2025, published around the 31st of December 24 or the 1st of January 25. The one from the year before was called Beat the Benchmark 2024 Beat the Benchmark. So I publish these portfolios regularly on LinkedIn, and I also send out a spreadsheet to anybody who asks me on LinkedIn, but I got rather overwhelmed with it last year. I sent out that spreadsheet literally hundreds of times. So this year, rather than sending it physically to everybody, I'm going to put up a link on a Google Drive, which anyone can download, and I'll leave that link on my YouTube profile. So anyone who looks at my profile will be able to see my profile, see what the link is, then go to the link and download the spreadsheet directly with all the stocks which are in the portfolio. Last year's portfolio had 40 stocks. There are actually currently 43 in it, because one of the stocks, Vivendi, I think it was, had a spin-off. It spun off 3 different companies. And actually, each of those companies is worth almost as much as the original purchase of Vivendi. So Vivendi effectively turned into 4 companies. So starting with 40 companies, there are now 43 in the portfolio. But the portfolios are designed to be held for the entire year. No purchases, no sales, no changes. All it will do is collect dividends. I don't count the dividends, but basically it's a static portfolio on the 1st of January each year, which I buy, or I might buy, or it's as if you bought it. I might buy all of them or some of them, and it's to be held throughout the year without changes. Those portfolios have, in fact, beaten the benchmark, as we can see by looking at the numbers. The 2025 portfolio called Beat the Benchmark is up 51.79% as of today, compared with the benchmarks, which are up about 17%, something like that. So let's go back to the questions and see where we were. Whose question we were on? Ernie, wasn't it? Yes, that was Ernie's question. Where was it? There we are. What's the next question? Next question is from Stuart. Stuart says, Dear Clive, I have just watched your building a benchmark portfolio. Very good indeed. A few questions. There has been much hype about the AI bubble. You're indeed right, Stuart. There's been a huge amount of hype. I mean, and a lot of incestuous behavior in the AI companies, with one company investing in the next one investing in that one, and then investing in the first one, and they're all calling it revenue, when in fact all they're doing is investing in each other, and the money is hardly changing hands at all. Anyway, that's just an opinion which is out there, widely spread on the internet, that there's a lot of these AI companies all investing in each other. They would say it's for good reasons because they're diversifying their risk, they're investing in their competitors, they're investing in their suppliers and that sort of thing. But the question is, at what point are they reporting this as revenue when in fact the revenue might be many years in the future? So that's all the hype about the AI bubble. Is it overblown? Is it overpriced? If we get a crash, well, here's a comment. Just because something is overpriced does not mean that there's going to be a reversion to the mean. If it's underpriced, again, it does not mean that it's going to rise to its fair value. It can happen, and your chances, if you buy something undervalued, something too cheap, the chances are in your favor that it won't get cheaper. The chances are it will get more expensive towards its fair value. And likewise, if you buy something which is overvalued, the chances are in the long run, it will revert to its fair value. But, things can stay overpriced for many years. You know what they say? The market can stay irrational longer than you can stay solvent. And, a good example of that is go back to 1996. Alan Greenspan, the chairman of the Federal Reserve, was commenting on the overpriced stocks in 1996 because it was a bubble after all. I mean, there were all these dot-coms coming out and things like that. And he said, well, he used the words describing the market as the market being full of irrational exuberance. It was a very, very famous expression at the time. And of course, there would have been people who sold their stocks. But just to prove the point that things can stay irrational for a long time, so the irrational exuberance carried on for another 3.5 or 4 years. So the bubble didn't pop until the year March 2000. So if you, from 2006, when he used those words, irrational exuberance, through to 2000, you'd have missed out on the next 200% of profit if you'd bought the S&P 500. So, yes, the stocks might crash, Stuart. We don't know. I'm not saying they will. I'm not saying they won't. I don't give investment advice. I cannot see the future. I mean, I have a crystal ball, but it doesn't really tell me the future here. I'd be better off reading the tea leaves. Anyway, let's read the question. If we get a crash, what is your policy to deal with this? Well, I don't deal with it. I accept it's a risk. I've seen perhaps 5 crashes in the 50 years I've been investing, maybe 1 or 2 serious market declines on top of that. So let's call it 5 to 7. What I can tell you is every crash I've seen has often been followed very rapidly by a bounce, a big bounce, and every crash I've seen has been followed at some point by another all-time high. And then another 5 or 10 years go by, and then there's a crash, and then it goes to another all-time high, even higher than the previous all-time high. So what's my strategy to deal with this? Well, he asked the question, hold and continue to hold through the bear market until you get out break even. Well, no, I don't think about getting out. This could take months or years, or sell at a loss. Well, my strategy is not to do anything. The problem with, even if you think the crash is going to happen, even if you're in the middle of the crash and you know it's happening and you sell, what's going to happen? You're selling because you feel negative, you feel bearish, you feel there's bad news. By the time the crash hits the bottom, your bearishness is going to be much more extreme. You've been vindicated by the fact it's going down. You were right to sell, and now it's down, you're vindicated. And of course, the news is going to feel much, much worse at the bottom. By definition, the bearishness has to be the worst at the bottom. It's going to feel much, much worse than it does at the top or before it fell. So because it feels worse, it's going to be a real mental challenge to buy at the bottom. Now, many, many people say they can and will do it. I've never yet seen anyone who sold successfully buy at the bottom. I've heard them talk about it. When it hits the bottom, they say, oh, no, look, I'm right, it's going to get a lot worse. This is proof. And then it bounces the next day and you never see the bottom. And then they say, well, if it gets back to the bottom again, I'll buy. And then it doesn't. So I know one person in particular who's been out of the market probably for 30 years now, after a I think it was I don't know, it was the 87 crash, I can't remember now, but I remember he came out, went into cash, and to my knowledge, he's probably still in cash to this day. I also know another person who came out on the worst day, or just before the worst day of the COVID crash. Was that 2021 or 22? I can't remember, but it was in March. Markets plunged down. He came out. He didn't come out completely, but he reduced his weighting from maybe 70% equities down to maybe 20 or 30. That will have, what he kept will have recovered a lot, probably doubled. But the reality is he could have had a much bigger part of his portfolio doubling. So my message is, no, I don't get out. I don't buy puts. I don't buy futures. I don't sell futures, and I don't buy put options, and I don't sell my stock. Obviously, if I have a cash need, I try to keep that in cash anyway, rather than gambling it in the stock market. But in general, I don't worry about that too much because I don't feel I have a cash need. Because by staying invested, I'm receiving dividends on the company, so I've got the cash flow anyway. What would I need to sell for? Just because the stock price goes down doesn't mean that the dividend goes down. So the dividends are going to keep coming. I mean, they might go down, but usually companies don't reduce their dividend if they can't, unless they got really bad profits. So probably the dividends will keep coming. It's just the price that I see. Think about it. If you buy let's say a telephone, an iPhone or whatever, you might pay $1,000 for it, and then 2 years later there's a better iPhone, but the old model's still on sale, but it's now only $600. That's what happens to the prices. They go up, they go down. If you look at a house, you might buy a house at 100,000. I might have bought a house at 100,000 10 years ago, and now it's 200,000. Do you say I won't buy it because it's up? Do you say I'll wait till it crashes back to 1,000 on the way down? No, the thing is, when you should be owning equities or should be buying something, just buy the good one, hang on to it, and it will still be a good one before the crash, during the crash, after the crash. Of course, the price will change. It might be a lot higher or a lot lower, but at least you're in there and you're not in the cash, which is constantly depreciating. So let's see if I've got any more questions for today. We're drawing to a close now. Yes, I've got another one here. This one comes from Noah. Hi, Clive. I have been following you for a long time now and have learnt a lot from your channel. I am 19 with about 15 grand. Grand is 1,000 in English terminology. I have about 15 grand currently invested in shares and bonds. Would there be any chance I can try out Markets Flare? Okay, I see where you're coming from, Noah. So Noah's seen that I'm affiliated, or rather connected, as an advisor to Markets Flare, which is an artificial intelligence program designed for institutional users, specifically designed for investment managers. So it's great on producing your investment reports in a standard format for your firm. You just say, I want a report on this company or that company, and it will produce it for you. You want a daily market report on what's going on in the market, it will produce it for you. It's obviously a very secure application. Your data is, on your information is not shared with third parties or with the AI itself. Your data doesn't leave the company. And of course, you can build portfolios and have it analyze every stock in the portfolio. So it's great for portfolio managers. But no, I'm sorry, it's an institutional product. The Markets Flare has to pay thousands to the data providers because the data is downloaded and stored inside Markets Flare tool in your office on a daily basis. So it's just a constant download. There's nothing going out. So everything's there, but that costs a lot of money, and every user therefore costs Market Flare a lot of money. So I'm afraid if you've only got 15 grand, you probably can't afford it. So no, sorry, you can't have a chance of trying it out. Otherwise, it would cost Markets Flare a lot of money for each user. Okay, next question, last question for today, from Rob. Didn't we have a question from a Rob before? It's not the same guy, I guess. Good morning, Clive. Thanks for sending the link to further analysis of gold's status. All that I seem to be able to conclude is that gold can be treated as equivalent to cash by national discretion, i.e. money itself. That's right, gold is money. I agree with that. The rest is all becoming like smoke and mirrors to me. And you're not alone, Rob. Lots of people are confused by finance and so forth. But if you've got some gold coins, you know how many you had before, you know how many you have afterwards, they're still there. Put money in the bank. Hey, it's depreciating every day, whatever happens, whether you like it or not. At least with gold, it could go up or down, but in the long run, it's appreciating. Not the gold itself appreciating, it's really the cash depreciated. The gold gets you more cash down the line. Now, that's not investment advice, that's just my opinion, okay? So I go back, so I'm reading the question. So I decided to go back to my original question concerning CBDCs. That's central bank digital currencies. That's the currency which is going to be issued by most governments, where it's issued by the central bank, not by your bank, and you have a direct claim on the central bank. It's a currency where you could be potentially controlled through your wallet by for example, they might say, you're getting your social security checks, so you can't spend it on alcohol or gambling. Just a small example. There could be many other examples. There could be much more nefarious ways of controlling your behavior, such as preventing you getting on trains to demonstrations or things or whatever. You know, who knows what it might be. Or maybe they just think you've eaten too much meat this month and now you need to go on a diet. I'm not saying it get that far, but we don't know. Let's read on. So I decided to go back to my original question concerning central bank digital currencies, from which it seems that the Basel Committee, Bank for International Settlements, is itself in catch-up mode. I think I'm going to have to duck out and leave the discussion to those who are more astute than myself. Looks like plenty of opportunity for free lunches to come for them, though. Oh, yeah, well, Rob, that wasn't really a question, but yes, indeed, there's going to be lots of free lunches for all those involved on the central bank digital currency front. Ladies and gentlemen, I'd like to thank you very much for watching this video. If you've got any questions, fire them and I'll try and answer them in a future video, or I'll put them under in the comments section and I'll look at all the comments and I will try and answer as many of them as I can. I know sometimes I get hundreds of comments and happy to have those comments. I do read them all, but sometimes I can't reply to every single question, but you'll certainly see plenty of the comments get replies. If you want more of this, like, subscribe, thumbs up. Thanks very much. Bye-bye, everybody.